Owning shares means owning a piece of a company, but most people have no idea how that actually works. If you've ever heard someone say, I bought shares in a company, or I'm investing in the stock market, and thought, what does that actually mean? You're not alone. In fact, most of us have been there, and that's why this video is for you. Let's be real, most people think investing means gambling, being rich, or just for the finance bros. That's wrong, and I'll show you why. I'm going to break down exactly what a share is, how people buy and sell them without needing loads of money, and why a company's share price can fall even when it's doing great. By the end, you'll understand how shares actually work in plain English with real UK examples, so you can feel confident in investing even as a beginner. Let's get started. What actually is a share? Think of your favourite company, maybe it's Nike, Netflix or Greggs. Now imagine that company as a giant pizza. If the company decides to split its pizza into slices and let other people buy those slices, that's basically what it does when it offers shares. So when you're buying a share, you're literally buying a small slice of that company. What do you get as a shareholder? Here's the menu. Ownership. You own part of that company. You're a mini boss, even if only in your head. Dividends. If the company does well, you might get a small payout. It's like getting a tip for being a loyal customer. Voting rights. In some cases, you get to say in a big company decision. You probably won't be picking the next CEO, but you can vote on stuff at the annual meeting. For example, if you buy 100 shares of Tesco, you're a small part owner. You receive a dividend payment, and you have the right to vote on certain issues. And if you ever feel fancy, you can tell your mates, I own part of Tesco's. Just don't expect a discount on your meal deal. Now let's talk about different share types. There are two main types that you'll hear about. Ordinary shares, these are most common. You get voting rights, and you get the chance to earn dividends. But if the company goes bust, you're last in the line to get paid. It's like being at the back of the queue of a buffet. Sometimes you get lucky, sometimes you're just left with the crumbs. Preference shares, you usually don't get a vote, but you're first in line if things go wrong. The dividend is usually more fixed and more stable. It's like having a VIP pass at the buffet. You get served first, but you don't get to choose the menu. In the UK, most everyday investors buy ordinary shares. Unless you're a financial wizard or a risk lover, ordinary shares are the best bet. So how do you actually buy and sell shares in the UK? To buy shares, you use a broker, like a shop that sells bits of companies. Some well-known UK brokers are Vanguard, Hargreaves and Lansdown, and AJ Bell. Let's say you use Vanguard, my personal favourite. It's known for its being low cost and simple to use. Here's how it works. Number 1, we open an investment account, like a stocks and shares ISA. Number 2, you search for the company or fund you want to invest in. Number 3, you decide on how much you want to invest, even if it's £10. And number 4, you choose between a market order, as in you buy now, or a limit order, you buy if that drops to a certain price. Number 5, you confirm and buy. What does it cost? Stamp duty is 0.5% on UK shares. That's a small tax you pay when you buy. Platform fees, Vanguard is about 0.15% a year. That's just gone up a little bit. That's like paying a small fee to keep your pizza slice warm. Some brokers charge per trade, some don't, but always check. A common problem is that most people think you need loads of money to invest. The solution is you can just start with a tenner. Consistency matters way more than lump sums. It's like going to the gym every day. It beats going for one massive workout. Let's break down what makes share prices going up and down. You'd think a company doing well equals price going up, and a company doing badly equals price going down. But it's not always that simple. Let's look at the two main things that move share prices. Company performance. This is the real stuff. Are they making profits? Are they growing? Are they spending money wisely? These are called fundamentals. If your company's doing well, its share price usually goes up over time. Market performance. This is about people's feelings, what they think will happen. It's driven by news, emotion and trends. Sometimes the whole market panics and even good companies get dragged down. Here's a real life example. During COVID, companies like Tesco were still selling loads of food, but their share price dropped because the whole market panicked. That's the difference between facts and feelings. Common problem is people panic when prices fall short term. The solution? Focus on long-term company performance, not market mood swings. It's like ignoring the weather forecast and just enjoying the seasons for what they are. Here's why all of this matters if you're investing for the long term. If you're investing for a house or retirement, focus on company performance. That's the stuff that really matters over time. If you're trying to trade short term, which is risky, you'll be more influenced by market sentiment. Most successful investors, like the great Warren Buffett, ignore the noise and focus on buying good companies at good prices. It's like buying a good pair of shoes. You want something that lasts, not that just looks flashy for a week. Sometimes, even as a company doing well, the share price can drop. Why? because the stock market is a bit like a moody teenager. It reacts to everything, even the stuff that doesn't really matter. Inflation going up, interest rates rising, political uncertainty, big tech changes, all of these can spook investors, and that moves prices. You don't need to be an expert on all of this, but it helps to understand that sometimes prices move for reasons that have nothing to do with the company itself. It's like your favourite football team losing because the referee had a bad day. Annoying, but not the end of the world. Now let's talk about a stocks and shares ISA. If your shares go up in value and you sell and you make a profit, that profit is normally taxed. But if you invest through a stocks and shares ISA, you don't pay tax on your profits or dividends up to £20,000 a year. So you keep more of what you earn. That's why I'd always suggest using a ISA. A common problem is that people forget about tax. So using the ISA gives you tax-free returns. It's like getting a free upgrade on your pizza slice and you don't have to pay anything for it. Now let's cover common mistakes that new investors make. Number 1, thinking investing is gambling. If you're buying random stocks based on hype, that's guessing, not investing. It's like betting on a horse because you like the name. Mistake 2 is trying to time the market. Nobody knows when prices are going to go up or down. Even the experts get it wrong. It's like trying to predict the weather in the UK. Good luck. Mistake 3 is panicking when prices fall. Stocks will go down, that is normal. You only lose money if you sell at the wrong time. It's like selling your car after a flat tyre. Just fix it and keep going. Let's say you invest £100 a month in a global index fund like the Vanguard FTSE Global All Cap. Over 10 years, assuming an average return of 10%, you'd have about £19,000. In 10 years, that's a new car. Over 20 years, around £68,000. Over 30 years, roughly £198,000. In 30 years, that's retirement freedom. Now compare that to saving £100 a month in cash for 30 years. You'd have 36,000 quid. But with inflation, that'd be worth much less. Common problem is that cash feels safe, but it loses value over time. So if we invest, we beat the inflation and we grow our money. It's like planting a tree instead of burying your money in the garden. A quick story to bring this home. If Lewis saves £20 a month in a bank from the age of 15 to 65, he has saved £12,000. Amara invests £20 a month into a global index fund over the same period. Her pot grows to £230,000. Same amount put away, wildly different outcome. That's the power of compounding, small amounts, investing consistently and growing massively over time. It's like turning a snowball into an avalanche just by rolling it every month. ETFs and funds versus buying individual shares. Individual shares, you buy one company, higher risk, potentially higher reward. It's like betting on one football team to win the league. Funds and ETFs, you buy lots of companies at once, lower risks, more stable returns. It's like supporting the whole league, more likely to win. For most beginners, a simple global index fund like the Vanguard Global All Cap or the Vanguard Life Strategy is a great starting point. They give you instant diversification, so your money's not riding on one company doing well. It's like having a balanced diet instead of eating a pizza every day. How to get to £100,000? Let's break it down. £100 a month at 10% takes around 24 years to hit. £250 a month hits in 15 years. £500 a month takes just under 11 years. Without investing it at all, just saving £100 a month would take 83 years to hit £100,000. And that's before inflation. Just let that hit home. A common problem is that £100,000 feels impossible. The solution is to break it down and stay consistent. Let time and compounding do the work. It's like training for a marathon, one step at a time. So finally, here's how you can get started today. Pick a low-cost platform like Vanguard, open a stocks and shares ISA, choose a global index fund, and start with what you can afford, even if it's £10. Make it monthly and stick to it. That is it. No hype, no shortcuts, just long-term investing. If you've made it this far, you now understand more about shares and how to invest in them than 90% of people at your age. So use it. Thanks for watching, and I'll see you in the next one.